Greetings, fellow investors. Welcome to Nordic Finans, where we help you realize your financial goals.
So if that's something you find interesting, please invest in the subscribe button and deposit a like on the video. My name is Marcus.
And I'm Lucas. And today we're gonna talk about how to find a good company to invest in. Remember, if we put this into its place in the investment cycle, this is after we've first found a lot of good candidates. Remember, that was the first video. Then we've sorted out the potential bad apples. We've also identified our own circle of confidence, so the company operates within an area that we feel like we're confident that we know enough about so that we can place our money betting on a company. And now we are honing in on finding like a truly great company, and now we think we've found the one. So how do we know that it's the one? Because you don't want to make a mistake here, just like in dating. So let's get into it. Warren Buffett often likens companies to castles, and this is something we did in a previous video as well, and today we're going to further develop that concept and really develop it into a tool that we can actually use when we invest.
Yeah, these are the boxes you would like your companies to tick. If the last video were things to look out for, this is more like a video on which things should be ticked if you want to find a truly great company.
Yeah, so imagine you're on a blind date and you have like your requirements, and these are the things you want at the least. If the candidate doesn't fill these wants, needs, then they're off the list, then you're on to the next one. So that's how we're gonna approach today's video. So we're gonna look firstly at the king or queen, which is going to represent the management. Then we're going to take a closer inspection of the castle walls, which is going to be represented by the company's financials. Finally, we're also going to look at the often forgotten but oh so important moat, which is the competitive advantage of the company. We will discuss each of these three aspects of the company and how you can properly identify, and by doing so, finding a truly great company.
Yeah, we can look quickly at the king or queen, or the management of a company. And here we have noted 5 different aspects, and this is not an extensive list. This is just 5 things that we think are important when you're looking at the management of a company and what you should be looking for. Once again, this is not an extensive list, so please let us know in the comments below on any of these points, the management, the financials, or the moat, if there's anything we have forgotten. But in our case, we have found these 5 great things we think that you should look for. And the first one is the founders. If the founders is still involved in the company, generally, at least I think that if the founders are still involved in the company, it's a good sign. They are usually a lot more passionate about the company than maybe outsiders that have gotten in afterwards. So definitely if the founders is still there, and certainly if they also have a clear vision of where the company is going and what they should be striving for, I think that that is a really good sign.
Yeah, I absolutely agree so far.
Then another point that I thought was also, this is a bit odd to be suggesting in a video, but we actually also want to mention if you have gotten recommendations about the management. Once again, this is pretty important in the aspect that if you are a new investor, you should generally also listen to a lot of what established investors are saying and what they are saying about the management. For instance, if Warren Buffett or Charlie Munger or any other well-established investors talks about the management in a favorable way, I definitely think that you could take that as a very good sign when choosing to invest in a company, because generally these established investors know more than you do anyway. So it's definitely good to look at what are other people's recommending. It's definitely not a requirement, because sometimes maybe you have found a company that they haven't looked into, but if you're looking into a company that there's already outspoken support for the management, that is generally a good sign, I think.
Yeah, can I add something here? In the previous video, we showed you how to use the investor relations, and I think you can actually use that to gain sort of a little bit of an extra insight, because what you're gonna find usually there are, depending on the size of the companies and how active the management is currently, but it's quite easy, or it's quite common that you can find interviews, for example, in the earnings calls, where they present the data themselves, and I think it allows you to get an insight and sort of a feel of the person. You shouldn't base your investment decisions on how you feel about someone, but for this like small aspect of the whole process, it's gonna help you get a better feeling for the company, I think.
Absolutely, I fully agree. Then also you should check that they are actually have done things to respect the shareholders and have good compensation policies. What this means is that we gave some good examples in our videos on which type of companies you should avoid. There we also mentioned that if the management has done poor decisions for the shareholders, for instance, paying out no dividends when there's clearly room for paying out dividends, or not buying back shares, not having any good plans on how to compensate investors, or for instance doing things that could even jeopardize the whole company, like taking on too much leverage or having too high bonuses for themselves. There are a lot of things, but if in general you can find a lot of evidence that they are not acting in the best interest of the shareholders, I think that this could definitely be something that you should be very cautious about. But you should also be aware that sometimes this could be that companies that are in a growing phase, that the management chooses to anyway pay out a dividend for a growing company. This is a bad sign generally, because it implicates that they are not choosing to grow the company and they are not trying to expand the company, and they don't clearly have a vision at that point. So if you see in growing companies that they pay out dividends or they do share repurchases, that means that they are not actively investing in the growth of the company, and that's generally not a good sign either.
Yeah, that's a really good point, and it's something to be on the lookout for. With bigger companies, this is not going to be something you have to worry about, but like with smaller companies that should really be in their growing phase, that's something you want to look out for.
Yeah.
Okay, moving on to the castle walls, which is gonna be represented by the financials of the company. Here we also listed 5 things. First, what we really love to see is that the debt is low or at least manageable. It should not be crazy high. Then the second thing we listed here was growing revenues. You absolutely want to see that, because unless it's like a huge company, and even then you would really want to see that the revenues are growing, because otherwise, unless you can pick it up super cheap, like what are you even, like how are you gonna make money? Then in like sort of relation to that, we always, or at least me, I always like to see a nice and comfy low PE ratio. I love that. And even though we've talked about this in the past, if you don't know what the PE ratio is, it stands for price to earnings ratio. We have a great video on that. I'm gonna link it here. It's just like, to say it really short, it's basically just if you buy a share, how long is it gonna take that share of the company to earn the amount of money you paid to buy it. If it's super high, like 100, that technically means that the current earnings ratio, you're gonna have to wait 100 years for it. So that's why I don't really like to see these super high, because even with a company that grows, like it's gonna have to grow a lot before it's gonna be worth that much to justify such a price. And you might say that then like, oh Lucas, you're never gonna see that, a PE ratio that high, but oh boy, especially right now, the prices are just, they're high. So like, this is just a really good solid way to get you down to earth and like really get some perspective. Then, so the fourth thing we have are consecutive earnings, meaning that the company is successfully actually making money year over year. And hopefully this would increase as well, but at the very least that they are making money and not losing money. That we want to see that.
Yeah, and in general, as this is a video where we're actually talking about things to look for, in our video when we talked about what to avoid, we mentioned that you should watch out for companies that are consecutively losing money, because that's generally a bad thing. And if you would see an ideal case, then it would consecutively earn money. That's not always going to be the case, but if you could find a company that is always having earnings and positive net earnings, then it would be a very interesting company to invest in, as it can even handle difficult times like recessions, and if it's an older company.
Yeah.
And that is definitely something you would like to watch for. And if you find a company that is pretty much always earning money, no matter what else is happening in the market, that is a very good sign, I'd say.
Yeah. And then finally here on this point, we also like to see, when it comes to companies that pay out dividends, that they do so consistently, not just like 3 years and then they skip 1 year. Like, unless something really extreme happens, they should be able to then actually pay out those dividends. Like, the amounts may decrease or increase from year to year, but they should be quite consistent over the long run with the dividends payout. That's what we like to see. Of course, again, if it's a growing company or a company that never pays out dividends, that's fine. But with companies that do, make them consistent. Thank you very much.
And then if we're going to move on to the moat, so this is more the competitive advantage of the firm and what makes them unique compared to their competitors. And here we have 5 points that we would like to point out. Once again, it's not extensive, but the first is that the product cannot be easily replaced. For instance, if it's a commodity that the company deals with, that might be a bit of a problem if there easily comes a replacement for the product. Say if they are producing one type of camera, for instance, and then another competitor makes a better camera in all ways, then probably the camera that your company is selling will be replaced by the other one, especially if it's better and cheaper. So this is a thing that you definitely want to be avoiding in that case, that the company can stay up to date and also have something unique about them, which is also the second point. And here we have actually written unique and or like a status product. Because for instance, I think that certain companies has managed to tie in a certain aura with their products that they are more luxurious in a way. And I am certain that you can think of a few brands like this, where they feel unique and they have a value in themselves because the product is related to a certain brand, which is usually tied to the certain company. And if you can find companies like this, it could definitely be a great moat, because no other company can make this type of product if it's tied to the brand name. Then the company owns this. I'm not so much into brands myself, but I know that it's definitely a factor that you should look out for if a company can successfully do it, because it could be a great moat towards other companies if they can manage to hold that brand.
Yeah, I can't stress this enough. Like, this is part of the strategy of buying wonderful businesses at fair prices. Like, the brand image is just gonna generate so much value over the long term if they can keep it in a like, even like, it doesn't even have to be like perfect, but just like a solid. If people think it's a solid product and they generally like the company, it's gonna be great for the share price as well in the long run.
Yeah, and these 2 points are kind of related as well, that either the product might be necessary or the company has a certain goodwill with the consumers. Because if the product is necessary, for instance, you can be pretty sure that there will be a consistent cash flow. A lot of medicine companies, for instance, I think like this. The flip side of this is if they have goodwill with the consumers and that the consumers actually feel good about supporting this kind of company. It kind of ties into the status and the uniqueness of the product, but this ties more into the company itself. If, for instance, the company has very good sustainability involved in their business, and for instance, they want to promote the environment, maybe they plant trees, for instance, for every product you buy or something like this, a lot of consumers will feel that they are actually feeling good about buying the product. Kind of the flip side of if it's necessary and they feel like they have to buy it no matter what. Does that make any sense, Lucas?
Yeah, it makes a lot of sense. So think something like a vegan product for a vegan. Regardless if you're a vegan yourself, but consider that you would be. For a vegan, when they buy vegan things, they feel like they're doing the morally right thing to do.
Yeah, so they actually feel good about purchasing the product of the company in that case, which would make it, I think this is more of an industry moat in that case, but there are certain companies that definitely can make this a company moat. I think that, for instance, a lot of people want to support, well, I'm gonna actually mention the company now, but I think a lot of people actually want to support Tesla, and that they are very like involved and interested in the company and want to support it. So that would make it they partially want the Tesla because it's a great car, but they also partially want it because they really want to support Tesla.
I think this also relates then to recognizability, and that the products are recognizable and that the company is recognizable. Again, Tesla would be a good example of this, where you have like you're gonna recognize a Tesla miles away, and I think that's just really good. It's like free advertisement in a way.
Exactly. And there are a lot of companies that have managed to do that. For instance, every time you see the McDonald's symbols, you know what kind of business is behind that logo. And all these kinds of things, if the company has managed to almost take a space in the public knowledge and that people immediately know what it is just by looking at a logo or the product or something like this, that's definitely something that could be interesting. Because it will once again serve as sort of a moat in itself, that it's so recognizable.
So with that, I would like to thank you so much for watching this. I hope you got some value out of it. Please let us know if you did. Also, please leave a suggestion if you have any. What would you like to see us do more videos about in the future? Personally, I'm thinking after this series we're gonna start doing we're gonna go back to the basics again, because we have become a lot better already. It's been almost a year already since we started this, so that's probably what we're gonna be doing. But if you have suggestions, other suggestions than the basic stuff, please let us know in the comments. And with that, all that's left for us to do is wish you guys happy investing.
Happy investing, guys, and stay in the castle.